Differences between accounting cycle and operating cycle. Accounting cycle versus operating cycle. Accounting cycle consists of the steps from recording business transactions to generate financial statements for an accounting period. Whereas, operating cycle is a measure of time between purchasing inventory, selling the inventory as a product, and collecting cash from the sales transaction. The main purpose of the accounting cycle is to keep track of all financial activities that occur during a specific accounting period, be it monthly, quarterly, or annually. Whereas, the purpose of operating cycle is to influences a company's liquidity and its working capital requirements. Keeping the operating cycle as short as possible increases the pace of cash flow and the company's ability to turn over products and grow its business. Accounting cycles focus on all the financial transactions that occur within a small business and have a larger business focus. This starts from entering the financial transaction into a financial ledger and then making any adjustments as needed. Whereas, operating cycles focus on inventory from its first listing as a receivable until it has been sold for a profit and therefore have a much smaller focus within the business. The length of time of an accounting cycle typically lasts for either a month or a year depending on how the small business wants to track its financial information. Whereas, the length of time for an operating cycle varies based on the inventory. The inventory is tracked from the time it is received until it is sold. This could be days, months, or even years. Accounting cycle contains 10 steps. These include analyzing transactions, entering them into a journal, posting them, preparing unadjusted balances, adjust, review adjusted balances, prepare statements, close, prepare closing balance and reverse entries. Whereas, operating cycle only consists of 4 steps. These include analyzing the receivables, analyzing the inventory, reviewing the cost of goods sold and analyzing the payables. Accounting cycle shows valuation of all financial transactions in a business, including salaries, sales, expenses, and profits. The accounting cycle gives an overall picture of the financial value of a small business in its entirety. Whereas, operating cycle values the expenses and profits of the inventory. The beginning and ending numbers in an operating cycle simply show how much money was made from the sale of the inventory. In short, accounting cycle records a transaction from the beginning to the end in a ledger and verifies that every dollar going into or out of many general ledger accounts is reported. Whereas, operating cycle documents how inventory passes through a small business from when it is first created until it is sold to a customer. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.